Hi, and welcome back to the Business Career College video series. This is Jason Watt, and in this video we're going to look at shareholder compensation, and this is part of an ongoing series. It's probably beneficial if you have already watched the video concerning shareholder compensation where we talk about math around the dividend versus salary decision. What we're going to look at here is not the mathematical considerations, but really the non-math considerations around dividends or salary. So you've got a business owner, and this business owner is making the decision whether to take salary as the income or dividends. Now, we know from our earlier videos, and our government has done a good job of keeping things consistent here, that the taxation is going to end up very, very close to the same. We're going to see nearly identical taxation here. So the net amount of tax payable when we combine personal and corporate taxation is going to be nearly identical. And you can go look at the other video and see the math that I've done around that. This is something that's been true in this country since about 2009, maybe 2014, depending on the type of dividend we're talking about. We're currently in the middle of 2015 here. It's May of 2015 as I record this. And to sort of emphasize that point, we do have some income tax changes around small business dividends, or small business income tax rates, sorry, that came out in this year's budget, in the 2015 federal budget. And those changes bring with them automatically changes to dividend taxation, which are designed to keep that integration intact. So we're going to see the small business rate come down over the next couple of years, 4 years, I guess, and then we're going to see the small business dividend rate also, or sorry, the small business dividend tax credit also come down at the same time because your business will have paid less tax. So we're going to give you less tax advantage when you take that income. So what are the differences then? Well, Canada Pension Plan is a big one. And this is one that has lots of different implications. So the thing to consider is that if you're taking income beyond the YMPE, beyond the year's maximum pensionable earnings, this is really about a $5,000 cost to your business. So the question here is, do you need to build a CPP benefit? And I suppose at this point I should issue my gentle reminder that this is intended as general comments on taxation and so forth and planning, and you do have to go and sit with a planning professional, an accountant, and so forth if this is relevant to your own particular circumstances. So do you want to build a CPP benefit, or do you want to save that $5,000? If you take dividends, you don't have to contribute to CPP. If you take salary, you do. So who needs a CPP benefit? Well, if I take that $5,000 and I go do good, disciplined things with it, if I save for my retirement and I buy insurance and so forth, some of the same things that Canada Pension Plan normally does for us, then I've probably made a better decision. But I have to be realistic about this. Am I going to actually take that $5,000 and do the right things with it? Or does it turn into something else? And if it turns into something else, then I should probably use Canada Pension Plan, which is this forced savings. Your age might have some bearing on this as well. A younger person, a younger business owner who has a lot of uncertainty ahead of them, probably has some kids and a spouse maybe counting on them, probably that CPP benefit is worth more to that younger taxpayer. A taxpayer who's closer to retirement and maybe has already built up a good Canada Pension Plan benefit may not get a good bang for their buck on that $5,000 they would be spending here. So your age and proximity to retirement certainly has some bearing on this. And the future uncertainty as well. Keep in mind that our young business owner probably figures that everything is going to work out great, but lots of things can go wrong. A disability or a divorce or a failure of the business, all of these things can happen. So then we look at some maybe less important considerations. We can look at income splitting. Now, if your shareholding is set up properly, this probably isn't that big a deal, but it is going to be easier to split income if we decide to take dividends. A little tougher if we decide to take salary, but if your shareholding is set up properly, this might not be that big a concern. Then we can look at the presence of RRSP room. And this is actually a little bit like the CPP discussion, where maybe a younger person who has more uncertainty needs that RRSP room. So you're going to have some T4 income here, which is going to generate RRSP room. And keep in mind your RRSP, and this varies a little bit from province to province, but your RRSP is going to have this element of creditor protection associated with it. So that can be attractive for a business owner, whereas if you take dividends, you have no RRSP room, you won't have the RRSP available. And then we can look at disability coverage. So if you're taking disability coverage and you have salary, this is going to qualify you for any group disability insurance. Now, at one time, we might have said, you know what, if you take only dividend income, you're not going to qualify for individual disability insurance. That's not really the case anymore. Lots of disability insurers will look to dividend income if you've got a history of it and you have some control over that as a valid source of income for the purpose of calculating a disability benefit. But if you're only relying on your group disability benefits, which is not necessarily appropriate for a business owner, but it may form an important part of your base coverage, then you do want to have some salary income. If you want to have employee benefits, now this one's a little bit trickier. This is quite a sort of high-end tax planning concept, and not all accountants or tax lawyers would agree with this, but as a risk management item, you are generally safer to take salary if you're going to take employee benefits, because your T4 income is what establishes you as an employee. The problem you may run into is that if you're only taking dividend income, then you may not have an employment relationship. And it may be then that your employee benefits are not taxed the same way as with somebody who takes only T4 income or takes some T4 income. And of course, you can have a mix here. You can take some salary and some dividends. You maybe take salary up to the year's maximum pensionable earnings and max out your Canada pension plan. Or maybe you take salary up to the RRSP limits, about $140,000 of salary, and then dividends beyond that. So there's lots of different considerations here, and a good tax planner will work with you to find the optimal mix. We can look at, this is again a little bit of a difficult point, but if you're looking to access your refundable dividend tax on hand, your RDTOH balance, you're going to have to take dividend income to do that. And we're going to deal with RDTOH in a separate presentation. But it is important to recognize that you have this sort of secondary benefit where now you can pull refundable dividend tax back into the corporation when you take personal dividend income. That can be an upside. So really, we have all these different factors. There is not a clear-cut line. This is not a very black and white sort of discussion. This is a discussion that has a lot of nuance to it, and it's very much dependent on your particular circumstances. And it might make sense when you're, let's say, under the age of 40 to do things one way, and then maybe as you move closer to retirement to do things differently. There are lots of different reasons why. It might depend on when you're planning to sell your business, or if you're planning to have your business into perpetuity. It might depend if you're looking to use the lifetime capital gains exemption at some point. So there are lots of different considerations around the salary or dividend discussion. I hope this is helpful. I hope this gets us at least recognizing some of those more nuanced considerations. And I hope that we recognize that the math, the actual amount of tax payable here, is going to be nearly identical in either case, and that shouldn't be a big influencing factor as to which decision we make. So I hope that's helpful. Thank you very kindly, and please enjoy your continued studies.